everyone, I'm the Tax Pro, and today is day 11 of our 90 Days to Taxes series, where I am taking new businesses or businesses that may be disorganized, and I'm helping you get organized for tax season. So we've been talking about some different types of expenses, and today is going to be no different. I'm going to talk about the business use of vehicles. So we're almost done with our expense kind of group of videos, and then we're going to move into some different topics. But today we're going to talk about the business use of vehicles. And I pulled up topic 510 on the IRS website, the business use of cars. Just as a reminder, any sort of guidance that I pull up on the IRS website, you can't use this in the event of an audit. It doesn't have what we call authority, but it makes a great place to start your research. So the actual Internal Revenue Code or different court cases, that kind of stuff, that has authority that you could potentially use in the event of an audit. This does not, but it has great information and it's a good place to start. So when it comes to writing off your vehicle in a business, there's two general kind of methods for calculating our deduction. The first is the standard mileage rate, which you're going to see on here, and then the other is the actual expenses. So when it comes to the standard mileage rate, what you do is you are going to calculate all the miles that you drove for business purposes for the tax year. And then you're going to multiply it by the standard mileage rate for the year. In 2025, we get to take 70 cents per mile. But for every year, that amount of cents essentially changes. It's adjusted for inflation. So last year for 2024, it was 67 cents. It's gone up by 3 cents. Generally, the IRS gives you a rate for the whole entire year. However, recently we have seen where that amount increased halfway through the year. Okay? So what you need to do is you need to be keeping track of your mileage, and preferably a mileage log that essentially gives information on what's the date, where did you start, where did you go to, and what was the purpose, what was the total miles driven. Okay, and this needs to be for business trips. So we need to look to see what sort of business activity you were doing. When it comes to driving from your home to a place of business or to a customer's location or something along those lines, if your home is not considered one of the primary places of business, that's commuting, okay? You can't take that mileage. However, if you have a primary place of business in your home and you travel for business to a different location, that's not commuting any longer, that's business use, okay? If you have questions about how to establish a home office as a primary place of business, go ahead and check out the video on home offices, okay? So you're going to tally up all the mileage that you drove that year for business purposes, and you're going to multiply it by that standard mileage rate. Alternatively, we have actual expenses. And right here gives us some information. You have to determine what it actually costs to operate that vehicle. So, this includes gas, oil, repairs, tires, registration, and depreciation, or lease payments if you're leasing the vehicle. Now, what is depreciation? I'm going to briefly touch on this. I'm not going to go into a ton of detail because I'm going to cover it in later videos. But essentially, with depreciation, when you purchase an asset, and let's say, we've purchased a truck. That truck is $40,000. We don't get to just say, I purchased it in 2025, therefore I'm going to write it off in 2025. And I'm going to assume for this example that this truck is 100% business use. So that full $40,000 is going to go towards the business. Okay? What we have to do is we have to say we're going to depreciate this truck. And we are going to determine the number of years over which we are going to spread that expense. So what is the total life of that truck? And we're looking at expected life, and the IRS gives us depreciation schedules that tell us the number of years over which we have to depreciate these assets. They have a whole slew of depreciation tables. They even have things like, how long do you depreciate cattle based on their use? How long do you depreciate horses based on the age that they were when they went into service and what their use was? So you're going to find your vehicles on there, okay? So So you're going to take the vehicle and then you are going to split up the cost of that vehicle over a specific number of years. And down here under depreciation, you'll see that it says generally we use the modified accelerated cost recovery system. We call this MACRS. So if I ever say MACRS, I mean the modified accelerated cost recovery system. MACRS is a method that essentially front loads the first year or two of depreciation on that asset. Okay, so it's gonna say the majority of the use that you're gonna get out of this asset is gonna occur early on, and then it's going to taper down. Okay, that's MACRS. The majority of assets are depreciated via MACRS. However, notice right here, if you use the standard mileage rate in the year you place the car in service and change to the actual expense method in a later year, and before your car is fully depreciated, you must use straight line depreciation over the estimated remaining useful life of the car. Straight line means that you get the exact same benefit every year. So if it is a 5-year asset, we are going to divvy it up into 5. That's what you get every year, okay? An even number. MACRS front loads, straight line is straight across the board. Certain assets you have to utilize straight line. So with actual, we tally all this up, including depreciation, and then we look to see how many total miles, business and personal use, was that vehicle driven. Based on that information, we then calculate what percentage of those miles was business use. And that's the percentage that we apply to all of those actual expenses, and that's what you get to deduct. So, for example, we looked at, let's say, for standard mileage rate. We've driven this vehicle 1,000 miles for business use, okay? We get 70 cents per mile, so we get to take $700. Now, let's say, alternatively, we're going to use actual expenses. We need to know business miles, and we also need to know total miles. So let's say we've driven this vehicle a total of 12,000 miles this year. Still 1,000 miles for business use, okay? So we're going to take 1,000 divided by 12,000. We're going to get 8.3%. We're going to take 8.3% of the actual expenses, and that's going to be our vehicle deduction. So if we have $5,000 in actual expenses, we get to deduct $417. Now, I want to point out a couple things. One, these are nice round numbers. You shouldn't have nice round numbers. You need actual calculations, okay? The IRS is not going to accept nice round numbers from you. I'm doing nice round numbers for simplicity's sake. You need to actually total up actual mileage, actual expenses, all of that. Now, also, I get a lot of questions. What is better, standard versus actual? What's going to get me more of a deduction? I'm not sure. It's going to be case dependent, okay? I'm unsure what's going to be more for your particular vehicle. I will tell you that the more expensive it is to operate your vehicle and the more expensive that vehicle was, the higher your actual expense deduction is going to be, okay? So if you have a more expensive vehicle, a vehicle that's not as fuel efficient or requires like expensive tires, repairs, maintenance, that kind of stuff, that vehicle may have a higher deduction when calculating the actual. If you have a very, very cost-efficient vehicle that is fuel efficient, that doesn't have a lot of repairs, standard may be more, okay? Now, you, right here, to use the standard mileage rate, you must choose to use standard mileage in the first year the car is available for use in your business. And then in later years, you can go either standard or actual. So the only time that you can use standard is if you've used standard for the first year, okay? You cannot use actual the first year and then switch to standard in later years. Okay. Other times that you cannot use standard is if you operate 5 or more cars at the same time in your business. They consider that a fleet. If you have a fleet of vehicles, you've got to use actual. You must not have claimed a depreciation deduction for the car using any method other than straight line. So if you start depreciating that vehicle under Mackers, you can't use standard. You must not have claimed a Section 179 deduction. So Section 179 is it's accelerated depreciation, so it's a way to get more depreciation in the first year that you place that vehicle in business. Same with this special depreciation. We also call this bonus depreciation. So there's some regulations on who can choose standard and who can choose actual. So now that we've gone over standard versus actual, let's go over what this looks like in each type of business. When it comes to a sole proprietorship, which files on like a Schedule C or a Schedule F, you're going to have a separate area in which to calculate your deduction for your vehicles. That one's pretty straightforward because it's literally on the tax form for you. Okay? When it comes to a partnership, you should have an accountable plan that essentially is written. It's a written accountable plan that the partnership declares how it's going to reimburse partners for mileage. For example, it may say we use the IRS standard rate and we reimburse. Or it may say we're not going to reimburse those partners, in which case you would claim your mileage as an unreimbursed partnership expense on Schedule E. Okay? So you either need an accountable plan that is going to describe how you are reimbursed for those expenses, or you take it as unreimbursed partnership expenses as long as the operating agreement of the partnership says you will not be reimbursed, okay? For an S corporation, you need an accountable plan. That accountable plan needs to be written and it needs to detail how that reimbursement is going to be calculated, okay? You need to be reimbursed from that S corporation. C corporations, you're essentially going to have an accountable plan that describes how employees are reimbursed for mileage, okay, and the calculation that goes along with that. For partnerships, S corporations and C corporations, as long as the partnership is reimbursing, that is a direct expense on those tax returns, okay? So it is written off on the actual tax return of the business. So that is kind of how you write off vehicles in a business. If you have any questions, please let me know. I do have one other thing that I want to mention. Certain vehicles that are over certain weights have a better deductibility or better code, I guess, that supports the deductibility. Let me kind of show you what I'm talking about. If you have a vehicle that is 6,000 pounds or under, you are limited on the amount of depreciation that you can take. Right here, you're going to notice that you're limited to $20,400 in combined Section 179 and bonus depreciation. So if you're depreciating a vehicle that's 6,000 pounds or under, you have a limit on that accelerated depreciation that you can take in that first year. That limit is then increased for vehicles over 6,000 pounds up to 14,000, okay? And then once you get over 14,000, then you don't have limits. This is to prevent taxpayers from going out and buying really just ridiculously expensive vehicles and trying to write it off in their business, okay? There are limits to accelerated depreciation amounts that you can take in your business on these vehicles, and it's based on weight. So if you have any questions, please let me know. I hope that was helpful. If it was, please consider liking and subscribing, and I will see you guys next time.